Is it even possible to find an area with good capital growth potential when interest rates are rising? Well, based on what most people in the media are feeding you right now, you could be forgiven for thinking that every single market around the country is crashing and that now isn't the time to buy an investment property, especially if you're seeing headlines like this. Let the bloodbath begin. House prices in Sydney and Melbourne could halve in worst crash since 1890s. House prices could fall by more than 40% in the worst crash since the 1890s depression, a new report warns. We're now in stage 2 of the bloodbath. Oh, I'm sorry. This is actually from February 2019, which was even before COVID hit. And we know what happened to property prices since then, right? I mean, they've nearly doubled in some locations. But don't the headlines you're seeing right now look remarkably similar to this from 2019? In fact, I could show you countless times when people predicted property prices would crash only for them to actually rise in value. That's why today I'm going to show you 2 things. Number 1, proof that areas can rise in value and often quite significantly when interest rates rise. And number 2, the 4 things you need to focus on to find these markets right now. But before I do, who am I and why should you bother listening to me? Well, if you've never seen my work before, hi, my name's Niro Thembipillay and I bought my first investment property back in 2002, 20 years ago. And strangely enough, the market back then looked very similar to what it does right now. We just had a couple of rate rises after an extended period of low rates, and people, again, were screaming that property prices were going to crash. Now, I lived in Sydney at the time, I still do, and I could see that the Sydney market, well, it would struggle because of the rising rates, but that wouldn't be the case everywhere around the country. So I decided to do my research and I bought my first property in a regional town in a totally different state. Many people thought I was crazy and that I'd lost my marbles. Yet those very same people were stunned to see that I doubled my money in 18 months. To be honest, I was too. I couldn't believe that my focus on data and fundamentals had worked so well. But here's the thing. The area that I invested in wasn't the only market that rose in value. In fact, between 2002 and 2008, there were 22 interest rate rises. And as I expected, Sydney and some other markets really struggled. But others took off. For example, property prices in Geelong and Victoria rose 86% in that same 6-year period. Armidale in regional New South Wales, well, it rose 117%. And Busselton in regional Western Australia, well, it rose a staggering 202%. The fact is that if you look through history, whenever we've had an environment of rising interest rates, certain markets have risen significantly. The problem though is, how do you find these areas? I mean, you can't just go and look through history and say, well, these areas grew last time when interest rates rose, so I'm going to invest in these same areas again, right? That doesn't make any sense. Past performance is no guarantee of future results. So what do? Well, let me share my 4-step process that I'm using right now to help our clients. Now, nothing I share is to be considered advice, right? I mean, I don't know your personal situation yet, so the process I'm about to share is based on my now 20 years of investing experience all around the country and 12 years helping others buy investment properties in multiple markets around the country. So, let's get into it. Step 1. Look at where demand is higher than supply. Now, that might sound really basic, but it's actually way more important than most people realize. You see, right now, almost every week you're probably hearing stories of builders going broke as costs are rising faster than they can keep up with. This is lowering the number of properties being built. In fact, according to the Australian Bureau of Statistics, or the ABS, the number of new house approvals in the 12 months to the end of July 2022 fell by 17.4%, while the number of units approved fell by 26%. Put simply, we're building fewer homes. But here's the thing, this reduction in new homes is not uniform across the country. In fact, there are many markets right now where they're pretty much building zero new homes. Why? Well, consider this. Right now, conservatively speaking, it costs about $370,000 to build an average 4-bedroom house, okay? Now let's say land costs about $300,000, which means it's going to cost someone $300 plus $370, $670,000 to buy a brand new house and land package in an area. But if the market price for, say, an existing 4-bedroom home that's really new or near new is around, say, $500,000, well then how can a builder justify building a package that's $170,000 above the market price? They can't. Nobody's going to pay that much, at least not yet, at least until that market rises. So that means that right now, there is virtually zero oversupply risk in certain markets. And if people are continuing to move into these markets, that means that demand is rising. So if demand is rising in these markets, but supply is staying the same because there are no new houses being built, what do you think that's going to do to prices? Now, add to the fact that at the recent Jobs and Skills Summit the government had, it announced skilled migration will be increased to 195,000 for the 2022 to 2023 period. So even on a national level, we're increasing demand without increasing supply anywhere near fast enough. Now, I really believe this is going to place a real rocket under property prices in the very near future. But of course, you need to target the right areas. So step one, focus on areas where demand is higher than supply. And then we come to step two, jobs growth. You need to look at areas where there's really strong growth in jobs, where they want more people to come and work in the area. Now, for example, one market we're targeting for our clients right now has its lowest unemployment rate in over 9 years. This area can't get people fast enough to move there to fill its jobs. This is what you want to be looking at. But unfortunately, this is where so many investors get it wrong. You see, you want to focus on jobs that aren't temporary or short-term. For example, if they're building lots of roads nearby or even a train line or whatever, that creates lots of jobs in the short term. But once, especially a road is built, well, most of those jobs go away. Instead, you want to focus on infrastructure like hospitals, which often creates more jobs after construction than during the actual construction period when the hospital is being built. And hospitals, for example, can be a real beacon. They attract people, which attract more amenities, which then attracts more infrastructure, and it creates a real self-perpetuating increase in jobs, which creates a self-perpetuating increase in demand for property. So make sure you're focusing on the right kind of jobs when you're looking at areas. But jobs alone are not enough. And that brings us to the third factor in our 4-step process, which is livability. Now, this is huge. You want to ensure you're investing in an area that is creating not only jobs, but also investing in amenities like schools, shopping centers, anything that's going to appeal to young families to come and live in an area. Otherwise, guess what's going to happen? You might find an area that has a huge investment in jobs, but without sufficient investment in amenities and livabilities, you'll see rents increase, but you won't necessarily see the capital growth you want. Why? Because people will move into an area for work, but they'll just rent there. They won't buy there because the area may not be suitable for their families. So you really want to get this right. Make sure you invest in areas where people are buying to live, where demand from owner-occupiers is higher than supply, and then you stack the odds in your favor of strong capital growth going forwards. And then, fourth and finally, we look at rentability. Look, in my opinion, I don't care what the story about the area is, how much you think prices might grow, how much infrastructure is coming. If you can't get your property rented, everything goes pear-shaped. No two ways about it. So you need to ensure you're checking the rentability in the area. You need to look at things like, what's the vacancy rate like? Are rents rising? Because if you can buy in a market where it's really easy to get your property rented, where there are often multiple tenants applying for each property, and where rents are rising, well then two things are going to happen. Firstly, and most important of all, you're going to have peace of mind. You're going to be able to sleep at night because you know you can get your property rented quickly and for a very strong rental return. Secondly though, rising rents can often be a precursor to capital growth, especially if you've ticked off the other 3 steps I went through before. So there you go. These are the 4 steps you want to follow if you want to find an area with great capital growth potential right now, an area that is quite likely to rise in value regardless of what interest rates are doing. Follow these 4 steps accurately and you too could find an area that rises significantly, just like last time when interest rates rose. And then you can sit back, smile at all those property naysayers, trolls, and doomsday folk. Hi, it's Nero here again, and thanks so much for watching. If you like what you saw and you're looking for a proven recipe, a blueprint on how to build a property portfolio that gives you passive income, then click the link below this video and get a copy of my book, Wake Up Wealthier, How to Build a Property Portfolio that pays you an income each and every month. Okay, when you click the link and you download your book, you can get both the digital version and the audio version in case you don't like reading. All right, so I used to sell this book for $49, but right now I'm making it totally free. Why? Because I want more people to get this information, and I know that a segment of you will then like what you see in the book and choose to reach out to find out more about our services. But even if you don't, if you're serious about building a property portfolio that pays your passive income, then you really want to get my book, Wake Up Wealthier. It contains the secrets that I have fine-tuned over the last 19 years. It's totally free for a limited time. Click the link below.